Hello, everyone, and welcome to the Weekly Watch. I'm your host, John Briggs. The tone of the markets and investors in the last few weeks has certainly been one of a glass half full. Ongoing moves that are reversing what had previously been 9-month trends of higher yields, lower stocks, and a stronger dollar. Even since the last CPI report in the U.S., we've seen the opposite: lower yields, higher stocks, and a lower U.S. dollar. This has contributed to an easing in financial conditions that one would think is something that, with inflation still high, albeit probably peaked, but still high, the Fed and other central banks will want to push back against. So enter Powell this past week, and here I'm going to bring in NatWest chief U.S. economist Kevin Cummins. Kevin, we're recording this right on the heels of the Powell speech. As noted, I would have thought Powell would have pushed back against easier financial conditions, actually the easiest since last August, which was a time when we did see the Fed come out pretty unified front against lower yields, weaker dollar, and higher equities that had gone against some of the progress they were trying to make by tightening policy rates. But he didn't really do that, did he?
No, I mean, I guess the market kind of took it as he's pre-announcing that the Fed's going to step down the size of, 75 basis points, supersized rate hikes to 50 basis points later this month. But I think similar to his November press conference, his remarks and comments in general were littered with hawkish rhetoric. He really didn't pull any punches. Once again, he made it very clear that stepping down the pace is much less significant than how much further the Fed needs to go and how long that they're going to hold policy at a restrictive level. And he referenced it saying that requiring holding policy to restrict the level for some time. So, I don't think the message is any different than it was at the November meeting, which he seemed to kind of distance himself a little bit from that policy statement which referenced the lags in policy and the cumulative tightening. But clearly the Fed doesn't want to prematurely loosen policy, and this rally is somewhat of a problem for them because it's kind of undoing some of the tightening that they're doing. So I think the main message was that the Fed's going to stay the course and get the job done. That's what he kind of concluded with his prepared remarks. And with regard to inflation, he acknowledged that the October data were, one report. It was a little bit better than expected, but he even went as far as including a forecast in his prepared remarks. So this morning we had the core PCE deflator, which came in a touch softer than consensus expected at 0.2. That was in line with our forecast. And the year-on-year did tick down from 5.1 to 5.0. But that was in line with what Powell had in his text yesterday that implied some forecast for October of 5%. So I don't think it really changes the message all that much, even though it was a little bit softer on the month-to-month basis this morning. But his message was inflation remains far too high. And, even though the October data showed a welcome surprise, I think was the language he used, to the downside, he did point out that it's just 1 month and it followed 2 upside surprises the previous 2 months. So I think the message is that the Fed, it has a ways more to go here as we go into, December and to next year.
So that's where I want to go next, and I'll come back to the inflation side of things. Has the speech or anything recently in the last few weeks since we spoke, has that changed your view on where the federal funds rate will go? I mean, market pricing in the near term changed a little bit. Before the speech, we had the peak in pricing was a little bit above 5%. Now it's a little below 5%. So in that way, not a ton has changed. But have you changed your views at all as far as where the Fed needs to get to as on his important terminal rate versus pace?
No, we haven't. We're still expecting a 50 basis point hike in December, and then continued hikes next year with a peak terminal rate of 5%. In November, in the November press conference, he did say that, relative to the timing of September, when we had the terminal rate at 4.625%, if we had to make those revisions now, in the summary of economic projections, it would probably be a little bit higher than where we were in September. So I do think that while the Fed is stepping down, they are going to be pushing that terminal rate, their estimate of the terminal rate, closer to our 5% estimate. So I think, what we're going to see is kind of an offset from the fact that they're stepping down, but they're going to remain, they're going to go a little bit more. Their expectation is to go a little bit more next year and to hold those rates on a higher level for perhaps longer than what they were thinking as of September.
Okay. And then since we're recording this before this week's payroll report, I won't ask you about the labor market. So instead, I'm going to ask about inflation. Does the inflation outlook, you say we've got a couple of prints here. Does that outlook change? Do you think it deserves markets to have a more comfort about the outlook? We have it declining. Previously, last time we spoke, you had it still pretty sticky through much of the year next year. Any changes there?
No, I mean, the October report was a little surprising, a little softer than expected. Clearly following the strength that we saw in August and September numbers. And it's definitely a welcome sign, but again, it is just 1 month. And if anything, we think that the core CPI report, which Fed officials will get on the first day of the upcoming FOMC meeting on December 13th, shows a little bit of reacceleration relative to October. It's modest. We're forecasting a gain of 0.4% on a month-to-month basis for the core. 0.3 on the headline CPI. It looks like energy prices are a little bit softer with gasoline and natural gas prices coming off in November relative to October. But the core is obviously what matters for the Fed. And if anything, I think it's going to continue to show pretty good, stickiness, particularly amongst some of the services components. So we're expecting a little bit of a reacceleration in rents after the surprisingly, tame reading of 0.6 that we saw in September. We're expecting that to be a 0.7 on the month, and we have a couple other components like transportation services, airfares, hotels, motor vehicle insurance costs, which probably are going to be a little bit firmer than they were in October. On the downside, we're expecting continued weakness in the medical care component, albeit less than what we saw in October. So I think, that sort of backdrop heading into the FOMC meeting is certainly not going to change the outcome all that much. And it's a reminder that, as Powell mentioned, he included some charts in yesterday's prepared remarks that, after you get strength in 1 month, we tend to see a little bit of softness, and perhaps after the softness that we saw in October, we'll get a little bit more strength in November. So I think, the jury is still out if inflation is going to get back down to their 2% target. And for right now, as he pointed out yesterday, it's moving more sideways than anything. The year-on-year pace of our core estimate of 0.4% for November would pull it down a tick. But clearly that's not anywhere near where the Fed wants us ultimately to see inflation go.
Yeah, they need percentage points, not tenths of percentage points over time.
That's right. That's right.
Yeah, so that all feeds into, again, like my initial reaction was one of, okay, I understand some of the optimism. It's just, maybe it's just that time of year, positions are off and looking for that Santa Claus rally, but just some caution here about how far to move things, because maybe he wasn't more hawkish than people were expecting, just repeating the prior, rhetoric. And that's given, a feeling of some optimism, some all clear, but I think we should be cautious about taking this too far, because the long run, we still got a long way to go. So thank you, Kevin, for joining us. Really appreciate it. And thank you all for joining us for this episode of the Weekly Watch. As always, please remember to hit subscribe so you can watch our latest episodes as soon as they're available, and hit the like button so it's easier for others to find. Thank you and have a great week.